Thank you for joining us today. Welcome to this virtual fireside chat on the top 5 KPIs for SaaS growth and profitability in 2023. I'm Ranjani. I'm the head of content at Spendflo. Today with us, we have Rike, who is the founder and CEO, which he defines as the Chief Evangelism Officer at RevOps Squared. Ray, would you like to tell us a little bit about yourself and what you're passionate about evangelizing?
Ranjani, thank you so much. Well, I bring about 30 years of operating experience from the subscription software model. And as the B2B SaaS industry has grown so quickly, I just saw a lot of new CEOs, CFOs, and go-to-market leaders that really weren't comfortable making metrics-informed and benchmark-validated decisions. So what I'm trying to evangelize is make sure that at your company level, when you have company performance metrics that you're reporting to investors, that they cascade down to every functional leader, marketing, sales, customer success, then they cascade down to every employee and understand the correlation and the relationship between all of those. So that's what I'm evangelizing.
Okay, excellent. So shall we jump straight to it?
Let's do it. Thank you. And I love questions, so please ask as many questions as you want, audience. Maybe put them into chat and I'd love to answer them. So, everyone's been talking about the growth at any cost. That's yesterday's news. And you need to have efficient, durable, profitable growth. But what does that mean? How efficient is your revenue growth? So what we started doing about 3 years ago here at RevOps Squared was building a B2B SaaS metrics framework so everyone could look at what is really driving company value at a process by process level. So that's kind of what we've done is we built a framework.
Okay, so what is the best SaaS revenue performance metrics framework? Can you walk us through it?
I don't know if there's a best, Rajani, but this is ours and is how we structure all the benchmark data that we collect, which over the last 2.5 years, we've collected performance metrics data that we've then turned into benchmarks across 15,000 unique B2B SaaS companies. And we've collected over 250,000 unique performance metrics data points. So this is the framework we use to analyze and then publish our findings. So if you look at the middle here, it's like what really drives a recurring revenue, enterprise value, or company value? Well, we have these 5 enterprise values of growth that we started the framework with. Of course, company growth is critical because we still are a growth industry. The efficacy of your customer acquisition investments, the efficacy of your customer retention and expansion efforts, what's your overall operational efficiency, how much gross profit are you actually generating for each dollar of ARR revenue? And then, of course, if you're have investors, whether that's venture capital or private equity, what's your capital efficiency? So when we look at company growth, of course, in the recurring revenue business, you're looking at things like your contracted ARR growth, your GAAP revenue growth, the Rule of 40, which looks at the mix of both revenue growth and profitability. And a lot of companies want to know how you're growing, new versus expansion ARR, and of course, your average revenue per account. But then you go into customer acquisition as a pillar of value, and you want to know things like blended CAC ratio, CAC payback period, customer lifetime value. And I think we're going to talk about the kind of top 5 for 2023. So I'm not going to get into the definitions of all of these, but if you visit our website at RevOpsSquared.com, you can see a 1 to 2 minute video of each one of these metrics, how to calculate them and what they are. We're going to hit the top 5 today. But then you think about customer retention and expansion. Of course, you want to know your gross dollar and your net dollar retention. If you have a smaller ACV product, like a $1,000, $2,000 product, logo retention becomes important. Expansion CAC ratio, how efficiently am I growing ARR in my existing customers? And then, of course, Net Promoter Score is a great macro summary of customer satisfaction. Operational efficiency, what's your gross margin, your revenue minus your cost of goods sold? What's your departmental expense ratio? How much of my revenue am I spending on sales and marketing versus R&D versus G&A? And then capital efficiency. And capital efficiency, once again, it depends on if you're self-funded or venture-backed, but it's things like, what's my ARR to dollar of capital raised? What's my ARR per FTE? How much free cash flow am I generating? So, Johnny, this is kind of at the macro level, that SaaS performance metrics framework.
Okay, but that is a lot of metrics. Are there the top 5 that you want SaaS companies to consider, especially when they're thinking about growth and profitability in 2023, when it's not the same as even the market that was 2-3 years ago?
You know, it's funny. I was brought up my first almost 10 years after undergrad. I was brought up at GE, General Electric, where one of the things, it was an amazing kind of management development program I was able to experience. And one of the things they always talked about is, you know, more than 5 objectives that any one person's managing simultaneously, then none of them become a primary focus. So what we did was we actually combined those 5 pillars of value of capital efficiency, retention, expansion efficiency, customer acquisition efficiency, and then revenue productivity or operating efficiency. And we saw where there was primary overlap, and that's where we got the top metrics or key performance indicators that are most important in 2023 for a SaaS operator. And they include, what's the efficiency of acquiring new ARR? You calculate that as CAC ratio. We're going to talk about what the formula is in just a minute, but how efficiently you're growing is measured by, for every dollar of sales and marketing that I invest in new customer acquisition or existing customer expansion, predictably, how much new ARR can I generate? Then we look at CAC Payback Period. This is, you know, for every dollar invested in sales and marketing, how long does it take to recoup that, measured against gross profit? So revenue minus your cost of goods sold. CAC Payback is one of the top 5. The Rule of 40. Rule 40 is still very important. It's kind of goes out of favor, comes back in favor. Right now, it's one of the 2 most important metrics to determine your revenue to enterprise value multiples. We'll talk about Rule of 40. Your CLTV or customer lifetime value to CAC ratio. And this really looks at how much gross profit is a new customer going to generate over its useful life, measured against how much it costs to acquire them. And you're going to see things like you're going to be generating 3, 4, 5 times more lifetime value than you invested. That's a pretty good return. And then your net dollar retention, which is really a compounded SaaS metric, which measures both how effective are you at retaining existing customer ARR, plus how effective are you at growing ARR at that install base. So these are the top 5 metrics we're going to go into a lot more detail on.
Mm-hmm. Can you walk us through how can CFOs evaluate the ROI of their SaaS investments using these metrics? If I was a high growth startup and I have I'm investing on a regular basis millions of dollars into buying and using SaaS tools. So if I have to measure the ROI on that investment, what is it that I should be looking at and how should I calculate it?
Well, we're going to talk more about that as we go through today's slides. But one of the great ways to understand why I selected these metrics was to look at public company enterprise value multiples and what's having the highest correlation to driving that. So what I've done here is I've taken 5 that have it's actually 6 because I added gross margin in there, that have the highest correlation to enterprise value to revenue multiples. And I want to give you a little bit of a stroll down memory lane. So January 22, it's really not that long ago, but by measuring the RSquared value, and that's how does one independent variable impact the dependent variable. It's kind of a logistics regression model. You notice, and by the way, it can be as low as 0 and no higher than 1. So revenue growth had a 0.51 correlation to enterprise value to revenue multiples. That's pretty high. And you can see AR growth rate was pretty high. Net dollar retention was very high. But things like customer acquisition efficiency as measured by CAC Payback Period, and even Rule of 40 had a lower correlation to enterprise value. Gross margin had almost none. Now, I'm not going to go through each one of these. People will get these slides so they can look at it. but I wanted to look at how did these evolve over time. So if we just go back 8 months ago in July, you see where revenue growth rate started to come down a little bit and its correlation. Net dollar retention came down dramatically. Now, this had some selection bias built in because high flyers in the public cloud marketplace like Snowflake, Twilio, and Datadog that had usage-based pricing, thus higher net dollar retentions, they started seeing the corrections in July, so that's why that became a little bit lower in July. Then you can see January 23, just 4 months ago. Wow, revenue growth rate was down even more to 0.31, but look at Rule of 40, which is measuring the profitability of your growth, right? Your growth rate plus your EBITDA or free cash flow percentage, 0.44. So it became the #1 predictor of enterprise value. So even in a private company, if you want to look at your next round, you can do this same correlation analysis. But now let's go into April. Things have started to get a little bit more normal. So you see revenue growth rate back up to 0.36. We're starting to see the early buds of paying a premium for growth again. You'll see where net dollar retention, it's starting to come back also because you're seeing some of the high flyers like the Datadogs and Twilios starting to grow again. Rule of 40, it's come down a little bit since January where everyone was about profitable growth. Now we're a little more focused on high profitable growth. It's up to 0.28. So it's still double the importance of enterprise value than what it was 15 months ago. So this is how the market and investors are evaluating. But let's get into some details, okay?
Yep.
Okay. Now everyone's going to say, come on, Ray, I've been in SaaS. I know what Rule 40 is, but it's always good to kind of revisit it because one of the things I've kind of done over the last year is I was a co-founder of the SaaS Metric Standards Board. It's the first industry initiative to standardize the SaaS metrics that everyone talks about because there's such an inconsistent calculation of those. So Rule of 40 is one of those that we're right now just getting ready to publish the standard. And the SaaS Metric Standards Board is looking at this as you take your growth rate plus your EBITDA as a percentage. A lot of private companies really aren't measuring free cash flow. They're not as capital intensive, so they don't have the same amortization that affects free cash flow percentage. So use growth rate plus EBITDA. If you've got your free cash flow percentage, you can replace EBITDA with free cash flow. And on the growth rate, we say do 2 rules of 40. Do one based upon your ARR growth rate, and do another one based upon your GAAP revenue growth rate. Why? Because if you want to aspire to be a public company, they're reporting rules of 40 based upon GAAP revenue, not ARR growth. Most private companies, they're more focused on that ARR growth. Number one, I talked about why it's back and popular again. I showed you those RSquared trends over the last 15 months, and that RSquared today at 0.28 has increased 2x from what it was 9 months ago. And once again, if you just go back 3 months ago, it had increased more than 3x. The Rule of 40 is important. Do we have any questions on Rule of 40 or should I keep going, Johnny?
Keep going.
Okay. So a lot of people want to know about benchmarks. Now, honestly, one of the challenges about benchmarks is how timely they are. Like we're just finishing up our 2023 benchmarking research right now. So we'll be publishing the latest benchmark standards from over 2,000 SaaS companies in May. So these are about 9 months old. But this was the Rule of 40 dating back to the second half of 2022. And you can see that company size, sometimes a proxy is stage of company, there is correlation to what your Rule of 40 is. Of course, when you're smaller, right, you probably have really high growth rates, 200%, 300%. So you're going to have a higher Rule of 40 because growth rate is half of the equation. But then you can see as you hit that 5 million to 20 million, you're investing more in your growth. You've invested in process and staff. You see the median comes down for 5 to 20 million to 29% Rule of 40, and at 20 to 50, 27. But then you can see how it starts to increase because as you hit scale, you're getting more efficient. So Rule of 40 is not the same for every stage of company. It's not even the same based upon your average annual contract value. So whenever you use benchmarks, make sure you're trying to compare to companies just like yours. By the way, this data was based upon a total population of 748 private SaaS companies. So now we're going to go to that next one I showed you, net dollar retention. So net dollar retention, really, it is a compound or multivariable SaaS performance metric that looks at the efficiency of both your customer retention, how good are you retaining the ARR that they signed up for, and then expanding them. So net dollar retention is going to factor in not only your churn and downsells, but also your upsells, cross-sells, and our organic expansion. It has become a very important metric if you have not just a product-led growth, but a product-led growth with usage-based pricing, because you're growing your install base as they continue the increased usage of your product so much. So net dollar retention, really a hallmark of usage-based pricing companies. We talked about it has decreased in correlation enterprise value a little bit. And be careful not to benchmark yourself against the superstars, because the companies that went public, they're already inherent selection bias. These are the people who went to IIT, MIT, and Harvard, right? They're the best of the best. So don't look at Snowflake and say they have 160% net dollar retention. That's where I need to be. And we're going to show you some benchmarks next, but you can always visit sas.kpibenchmarks.com to see all the benchmarks for companies just like yours, segmented by company size or ACV or go-to-market motion. But if you look at the latest net dollar retention for private companies, you'll see it's not 130 or 140%. The overall median was 105% last year. And you can see how, as a stage of the company, it doesn't change that much. However, what I'm not showing you, and I invite you to visit saskpibenchmarks.com to look at, is ACV, the size of your contract. That's where you're going to see a significant difference. A 1K product is going to see like a 78% net dollar retention, where a $100,000 product is going to see more of 109 to 110%. So the number one correlation to net dollar retention benchmarks is the value of your average annual contract. So it's net dollar retention. Now we're going to move to the third KPI and metric that we think is really critical for 2023, and that's CAC Payback Period. And CAC Payback Period measures the number of months it takes to pay back acquiring a new customer on a gross margin adjusted basis. What that means is it uses not your revenue that you get to pay back, it's the actual gross profit. So it factors in your cost of goods sold. The key here is CAC Payback Period should really be focused on your new customer acquisition. Because if you add in your expansion growth, you're going to get a artificially low CAC Payback Period. So just look at your new name customer average annual contract value across all your new customers. You'll see that the RSquared factor has decreased slightly over the last 9 months, but it's really not that high of an impact on public company enterprise value to revenue multiples. As you saw, it's more important for your growth rate, your Rule of 40, and your net dollar retention. And once again, you can see the CAC Payback Period benchmarks for your company at this site, but let's look at them real quick based upon ACV. Now, what's interesting about this is for less than 1K, this particular cohort had a 10-month CAC Payback Period. But when I really did a more granular analysis, a lot of this was product-led growth companies with usage-based pricing built in, because it takes a little bit longer for them to get up to that full ramped run rate. So you're going to see a little bit lower CAC Payback Period at the beginning of a PLG / usage-based pricing model. And then over time, it's going to normalize. But you'll see here where that CAC Payback Period, notice how it continues to increase as ACV goes up. So if someone says, oh, you should have a 12-month or a 14-month CAC Payback Period, that's got to be looked in context of your average annual contract value. Because if it takes for a $250,000 product 23 months to pay that back, what you're really going to want to look at is what's the customer lifetime value of a customer who's spending $250,000 a year. And that's where you're going to really look at that return on investment for that sales and marketing investment you're making in acquiring each new customer. So this is CAC payback period benchmarks based upon average annual contract value. So we've got 3 down. Let's go to the 4th KPI, blended CAC ratio. Now, often I put a little no SaaS magic number here. I much prefer blended CAC ratio over the SaaS magic number because it tells you something that's very intuitive. It's like, wait a minute, if I want to grow $1 of ARR, how much sales and marketing investment am I going to need to make? So if someone says, you need to grow your ARR by 5 million next year, well, if I know my blended CAC ratio is 1.5, I just multiply 1.5 times 5 million. I know I need to invest $7.5 million of sales and marketing. And also, CAC ratios you're going to see in a minute is you can calculate not only for both new customer ARR growth plus existing customer ARR growth, you can deconstruct that and only measure your new CAC ratio. So how much sales and marketing investment am I making for new ARR only, from new customer logos? Or expansion CAC ratio is going to measure how much sales and marketing and customer success investment do I need to make to grow $1 of expansion ARR from my existing customer. Now, one of the things we don't have time to talk about today is for all of these metrics, you should really understand what are the input variables that impact this outcome or lagging indicators. An example, what impacts CAC ratio? Well, your CAC payback period, right? If you can reduce your customer acquisition cost and reduce your CAC payback period, you're going to have a lower blended CAC ratio. The more you can actually grow from existing accounts, because it has a CAC ratio that's about 2 to 3 times lower than new customer acquisition, that's going to lower your blended CAC ratio. And blended CAC ratio also directly impacts EBITDA, because if you acquire new revenue for less sales and marketing, your EBITDA is going to go up because your operating expense is down. So all I'm going to say here is you really need to understand how when you have a high-level company metric, what are the input signals, i.e. the leading indicators that impact that. And blended CAC ratio, it's going to go up and down on a monthly or quarterly basis. So we recommend that you always look at this on an annualized basis over 4 quarters. And the timing of when the expenses go into the CAC ratio formula can change based upon how long the sales cycle is. And very simply, the longer the sales cycle, the longer period of time you're going to measure how much marketing investment you put into creating that opportunity. This is all on the SaaSmetrics board.com site, so you can look at the standard calculation formulas for all of these metrics.
If I may just interject, we have a question about whether you would include partnerships in CAC. Anthony Vega wants to know.
A great question, and our answer is yes. Because most partnership programs are part of either sales or marketing. They're part of operating expenses. Their primary goal is to generate partner influence pipeline and thus revenue. So partnership programs are definitely part of your customer acquisition cost calculation, thus your CAC ratio calculations. Yep. Now, in fact, I would go a step further. Best practice companies, especially more mature B2B SaaS companies, they will measure the CAC ratio by channel. So here you look at how much am I investing in partnership programs, fully loaded, with salary cost, variable compensation cost, any infrastructure, like if you have a partner referral tool, et cetera. And then you divide that by the amount of closed ARR that was driven by partners. That's going to give you a partner program CAC ratio. Same thing with sales development. right? These departmental CAC ratios are so important to understand the payback. Every dollar I put in partners or every dollar I put in sales development, predictably, how much am I going to get back from both qualified pipeline value and from new ARR value from that source? Okay, we're going to move from blended CAC ratio. Now, this is why I like it so much more than SaaS magic number. I can tell you $1.33 is the median across the entire population here. At median, B2B SaaS companies have to invest $1.33 of sales and marketing to generate $1 of new ARR. New ARR being either from new name customers or existing customer expansion ARR. You'll also see how the cost of blended CAC ratio goes up as your annual contract value goes up. So once again, ACV has a high correlation to your blended CAC ratio, which at the inverse, it's going to have the same impact on your CAC payback period, right? The lower your CAC ratio, the shorter your CAC payback period. A key difference though, CAC ratio is typically not factoring in gross margin into the calculation where CAC payback period does. That's why I like CAC payback period at the higher level and then move to your CAC ratio at the actual customer acquisition motion level, like marketing, sales development. Okay, expansion. Now, everybody heading into 2023 has said, excuse me, I just got to clear my throat for a minute. Well, it's more efficient to grow ARR with your existing customers than it's to acquire new customers. But 9 out of 10 companies don't measure that. What exactly does it cost? So 2 things we recommend you measure. Number 1, what is your mix of total growth that comes from expansion versus new name customer acquisition? And you'll see here, the median for the overall population is 30%, but as companies increase their ACV, you typically are going to find a higher percentage of your growth coming from existing customer expansion than from new. The other thing that's really important is multi-product portfolio companies. Those who have 3 or 4 products are going to have a higher expansion percentage, because they can go from selling just product 1 at the initial point of acquisition to products 2, 3, and 4 over time. In usage-based pricing companies, where if your customer is growing in the usage and so expansion revenue just grows organically, you can see a much higher expansion AR percentage based upon your go-to-market motion and your product portfolio and your pricing model. And then we talked about this when I mentioned the blended CAC ratio. It is so important to try to capture how much you're investing in expansion growth revenue. It's much easier when you have a dedicated account management team and what they are responsible for is renewals and growth. We have a growth marketing team and their primary responsibility is customer growth marketing. But if you have shared resources that do both new customer acquisition and growth, it's harder, but you need to at least go ask 2 or 3 questions for the people who are working with existing customers. How much of your time do you spend on existing customer growth versus new? It's not going to be precise, but if your customer success person's like, well, I spend about 50% of my time on trying to identify upsell opportunities or to get them to use the product more so there's more organic growth, that's better than not knowing that what you're at least directionally spending on existing customer growth. So this is going to measure the amount of investment you're making in growth divided by the amount of ARR growth you have from your existing customers. It's also really important going into planning session. They're like, okay, we have 10 million ARR. We want to grow by 7 million. How much of that should come from growth? Well, number 1, you can look at your percentage mix from the previous slide, and then you can look at your expansion CAC ratio and say, well, if we want to grow 3 million in expansion, we're going to need to invest X dollars to grow that 3 million from expansion. So at least you have some good quantifiable data to do that planning and modeling. And looky here, we talked about $1.33 being the median for blended CAC ratio, which is new plus expansion. This is just the expansion CAC ratio. And you'll see how much lower it is. You at median, it's 69 cents of operating expenses, sales, marketing, customer success, to generate $1 of expansion ARR. So it's much more efficient. Now, you've got to have the other attributes, things like a multi-product profile, the packaging and pricing that allows you to get organic expansion. You got to have the focus and the motion that really has some repeatability for expanding existing customer relationships. But this actually tells you how efficient it can be to grow your existing customer ARR against blended and against new CAC ratio. Going to move to one of the final top 5 KPIs and metrics for 2023. And it's truly a multi-variable metric, and it's customer lifetime value to CAC ratio. And what it does is it looks at how much revenue on a gross margin adjusted basis, so it's really how much gross profit you're going to generate over the useful life of a customer, measured against how much investment your customer acquisition costs for each new customer. This is a critical capital efficiency measurement for investors, because they like to know, it's like, well, wait a minute. So if I invest 20 million in sales and marketing this year, how much gross profit am I going to be generating over the useful life of that customer? And you'll see the benchmarks when you're going to invest 20 million, but it's going to generate 80 million of gross profit over 8 years. That's a really easy investment decision to make, right? So it's not just how much revenue, but it's how much gross profit measured against how much it costs you to bring in that customer. As I said, it's a multi-variable formula. So you need to know not only how much you're investing with sales and marketing investment, you need to know your gross margin for subscriptions. You need to know your churn rate, because the calculation actually includes churn. We recommend you do that on a dollar basis. And by the way, the way to get churn on a dollar basis is you just take 1 minus your gross revenue retention rate. Let's say it's 86%. So your churn's 0.14. And once again, if you want to see it for your like company cohort, you can go to SAS KPI-benchmarks.com. And sorry, this slide, for some reason at the last minute got a little bit blurry, but you can see the median on this. A lot of people have been using the age-old, it's a 3x. Your customer lifetime value should be 3x that of what your customer acquisition cost is. That's kind of like 2017 data. We've done this over the last 3 years, and it's hovering right around 4x. So your customer lifetime value should be 4x at median, 4.2 actually in this research. When you divide your CLTV by customer acquisition costs. It's very important also that when you're really young and you haven't had at least one full renewal cycle, but most preferably 2 renewal cycles, your customer lifetime value could be artificially high because you don't know your churn rate. But I had one company that was 2.5 years old, and I asked him what his CLTV to CAC was, and I said, I didn't ask him. He actually volunteered. It's 29 to 1. And I'm like, wow, that's really high. I go, let me ask you some questions. And what I ended up finding out after like 5 questions was he did all 3-year contracts. He'd only been around for 2 years. So he hadn't even had one renewal cycle, but they still had a couple attritions, 3 to 3 year going over. And I'm like, you just can't, you can have a infinity CLTV to CAC if you don't have at least 1 and preferably 2 renewal cycles. So with that, one of my kind of mentors and people that I follow is Dave Kellogg. You can follow him at kellblog.com. Don't ever be a slave to one metric. Understand the best revenue efficiency metrics for your company. Pick those top 5, right? Understand the interplay and the trade-offs, right? You may sacrifice a little bit on CAC payback period to have a little bit higher growth rate. You may sacrifice a little bit on Rule of 40 to have a higher new customer growth rate. So understand the trade-offs and don't be a slave to one. Look at the enterprise value correlation to these benchmarks. It really can be a really good GPS of where I should focus. And never, ever forget that a lot of these metrics that all the pundits on LinkedIn are talking about, like NRR or CAC Payback Period, right? They're lagging indicators. You really need to build your own framework and say, okay, these are the 5 lagging indicator, i.e. SaaS performance metrics that our investors want to see. What are the leading indicators that have a correlation to those? Even things like win rates or your average ACV, which are a sales metric, they have a direct correlation to CAC Payback Period and to your CAC Ratio. So just understand those, then have your departmental heads understand the reason that sales cycle time and ACV is important for your head of sales is the impact it has on your CAC Payback Period or your Rule of 40. So with that, Johnny, I'm pretty much done. So before I go to the next slide, any other questions you have for me?
Now that seems like the right time to talk about Spendflo and what we do as an organization. All of these metrics, the one thing that I do see is keep your costs low as much as you can. And that's what Spendflo likes to do. We help companies buy, manage, and secure all of your SaaS tools with guaranteed savings. We make sure that our clients pay the best price for the SaaS tools that they buy. In addition to the all-in-one platform, we also have expert buyers who get the best deals. If any of you is interested in seeing how much you can save, I would like to quickly open up a poll. And if you can tell us, if you'd like to know how much you can save on your SaaS spends, there you go. We'll let people answer that question. And I have one for you. Can you tell us about the common mistakes people make while using these metrics and the benchmarks that you've just shown us?
Well, I'll start with the thing I just said earlier, and that I really learned from Dave Kellogg. Don't be a slave to any one metric, right? Because if you say, it's all about net dollar retention, right? Well, if you focus 80% of your resources there, you might see your new customer acquisition really suffering. And new customer acquisition is going to be key to your long-term growth. So that's number one. Number two, consistency of calculation. And that starts with the instrumentation of your source systems, your CRM, your marketing automation, even your financial management, where a lot of your expense data comes from. So you got to have all this information to do the SaaS metrics calculation. And number two, if you're going to try to benchmark yourselves against external benchmarks, understanding what the industry standards are for the mathematical calculations, the formulas. One simple example, CAC Payback Period. CAC Payback Period should always be gross margin adjusted. If you don't calculate CAC Payback Period on a gross margin adjusted basis, it's going to be higher. You're going to say, well, I'm 25% higher than my competition. And it's like, well, yeah, because you didn't factor in your 25% cost of goods sold when you're doing CAC Payback Period. And then for me, the biggest value that you can really increase through SaaS metrics is making sure everyone in your organization, but especially your executive team and department heads, that they know what the SaaS performance metrics that you're prioritizing are because of your board of directors or investors. So let's say it's Rule of 40, growth rate, net dollar retention, and CAC Payback Period, and that they know what are their goals and objectives and how do they impact those company level performance metrics. Because if you just say marketing, okay, your goal is qualified leads or even pipeline without being able to link that to what you're presenting to the board of directors, it doesn't have the same emotional and intellectual impact. So create your own framework and understand what leading indicators and signals impact those lagging indicators. So that'd be my advice.
Okay. Excellent. If the audience has any question, please do let us know, type them in, and we'll do our best to answer them. We're almost out of time. Any last thoughts, Ray?
Well, I love the fact that Spendflo actually does these webinars, and it's really about thought leadership and sharing information that's not really selling Spendflo. So good on you. Now, I will say, you said something earlier, and I got to really highlight this. If you think about net dollar retention, one of the key elements of that is your gross dollar retention or gross revenue retention. You think about some of those leading indicators, yeah, it's net promoter score, it's customer satisfaction, but there's something that Spendflo does, which is sentiment analysis. And that is, how would your customer feel if that tool was taken away? And does it add real value to your company? So understand how your customers are feeling about your product, both your users and your economic buyers, because that's going to be a very important external signal to your gross revenue retention. So I know you do it for your customers, but everyone should be doing that with their customers. And then the last thing is, benchmarks, we think they're so important. And we have the industry's largest benchmarking survey. So we'd love for people to go to, you see the link down there. It's, the bit.ly SaaS Benchmarks 2023. Go ahead. If you want early and free access to the latest industry benchmarks for companies just like yours, your cohort group, you participate in the benchmarking research, you're going to get free access to see how you measure up in 2023.
Okay.
The other thing we're doing, just like Spendflo, we are here to try to help inform and educate the market. So there's lots of different things out there, like these SaaS metrics overview. You can go to our KPI overviews. The SaaS CFO, Ben Murray, and I do a monthly show where we dive deep into a particular metric. That's Monday Night Metrics. And all these RSquared factors, you can monitor these real time at meritechcapital.com, so you can see how they're evolving over time. And with that, just thank you so much for inviting RevOps Squared and for me to be here with you today.
One other question, if you have a moment for it. Someone wants to know, do these metrics apply for vertical SaaS as well?
They do. The metrics apply. There's additional metrics that are going to be important into vertical SaaS, right? Especially if you do things like gross merchandise value, GMV, and you take a percentage of that, which is one of the things a lot of vertical marketplaces do. The acquisition cost of suppliers can be a whole different part of your operating expense. So they do apply, but the benchmarks will be different. We don't specialize in looking at vertical marketplace benchmarks, but hopefully maybe your investors, or there's other sources for that. I can't tell you a good source other than Bessemer Ventures, because they started over-indexing on vertical marketplaces 3 years ago. They've got some research. I would say go to Bessemer Ventures and see if there's good benchmarks there.
Okay, excellent. That's everybody. Thank you very much and have a good day.
Thank you, everyone. Thank you, Rajani.